Good morning. Welcome to AmericaFirst Wealth Management Investment Outlook for quarter end March 31, 2025. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at AmericaFirst Wealth Management. Turning to our disclaimer, this information is just for informational purposes, doesn't constitute any investment advice, and our opinions are subject to change, and it's currently based on data for March 31st. Reliance upon this information in this material is at the sole discretion of the viewer. Thanks for tuning in. Turning to our market outlook, market highlights last week. Inflation was higher than expected, consumer spending was less than expected, and personal income was higher than expected. The core PCE, which is the Fed's favorite indicator of inflation, was up 0.4% in February, 0.1% higher than the 0.3% expectation. Also, for the 12-month core PCE was up 2.8%, also higher than the 2.7% expectation. Consumer spending grew less than expected, up 0.4% for the month, less than the 0.5% expected forecast. Personal income rose 0.8%, higher than the 0.4% estimate. Escalating trade tensions continued last week, with the Trump administration announcing a 25% tariff on auto imports effective April 2nd. And because of the higher inflation numbers and the escalating trade tensions, investors shifted towards safe haven assets. We saw gold being a safe haven asset, and also treasuries, certainly as stock markets fell strongly during the week. Investors took a flight to safety and went into a risk-off mode. Our outlook, unfortunately, is not a good one. We do have further tariff policy developments, with Trump announcing additional tariffs, which are likely to occur this week on various trading partners, calling Wednesday, April 2nd, Liberation Day. We certainly expect further market volatility because of this. Key economic events for the week. Tuesday, we have ISM manufacturing PMI and the JOLTS job openings data. Wednesday, ADP employment change and factory orders. Thursday, initial jobless claims, ISM services PMI. And Friday, non-farm payrolls, unemployment rate, and Fed Chairman Powell is giving a speech on Friday. There are only two S&P 500 company earnings this week, all occurring on Thursday: ConAgra and Lamb Weston. Turning to weekly market stats ending Friday, March 28th. As you can see, everything was red for the week, and it wasn't a good week. Small caps, technology stocks, growth names all took it hard on the chin. The iShares Core US Bond ETF was essentially flat, down 1 basis points. Looking at the year-to-date now, everything stocks except for large cap value, with the Russell 1000 value ETF being the only domestic stock index up 1.05%. International stocks fared better, with the EFA ETF up 9.06%, and bonds, as measured by the aggregate bond ETF, up 2.54% year to date. Not a good first quarter, it looks like, and certainly all the activity we're seeing with tariff policy on and off, volatility regarding that. Seems to cause investors a lot of concern and shifting towards a risk-off mode. Turning to the Magnificent Seven, only Tesla was up for the week, up 5.97%. However, as you can see, it is the worst performer in the Magnificent Seven year to date, and all of the names are negative, with Meta being the one that's down the least, down 1.41%. But the majority of the names are down double digits year to date, and it is not a good start for the Magnificent Seven names. Turning to the sector performance for the week, we do have some positive performing sectors, mainly in defensive areas, consumer staples, energy, real estate, consumer discretionary. As we know, Tesla is a big component of that. Tesla being the only name in the Magnificent Seven up is reflected in the sector ETF being up 7 basis points. You can see at the bottom, tech stocks got hammered, down 3.37% for the sector. Communication services, second worst, down 1.62%. Not a good week for stocks overall as investors sold off, going into a risk-off mode at near quarter end. Year to date, we're looking at a consumer discretionary being down the most, led down by Tesla, obviously, and tech sector being down second worst for the year to date. Best performing sectors year to date are energy and healthcare. Turning to the S&P 500 chart for a 1-year period, we continue to be down below the 200-day moving average. As you can see, after the first break, we did have a recovery to the 200-day, but we've reversed at the 200-day and are heading negative again. The RSI below is heading towards the oversold area. It looks like we're going to be testing the recent low that occurred in March. And let's see what happens as we enter into the new quarter in April. The dollar index continues to be weak, below the 200-day moving average, slightly oversold on the RSI. We did have a slight recovery last week, but towards the end of the week, it turned down again as the tariff talks weakened the dollar and caused the drop in the dollar again. Bitcoin, we had thought was hugging the 200-day moving average, but it looks like it's broken below that now. So we're seeing some weakness in Bitcoin, struggling to stay above the 200-day moving average. We've been watching Bitcoin as a indicator for stocks in general, which is why we follow it. We don't directly invest in Bitcoin, but in recent months, it's become a pretty good coincident indicator, slightly leading indicator for the market. So we watch it. Gold, as we've noted, continues to be quite strong, starting to accelerate a bit above the 200-day moving average. RSI is a bit oversold. We wouldn't be surprised if there was some profit taking or pullback, but the chart to us remains to be pretty strong, and this type of chart we would probably buy on the dips. We thought we would show the year-to-date chart. This is a Magnificent Seven ETF versus the S&P 500 versus gold and Bitcoin. And you can see gold is up. The gold futures are up year-to-date, 17.39%. S&P 500 down 5.11%. Bitcoin down 12.51%. The Magnificent Seven ETF is down 15.42%. So you can see a clear leadership shift in gold versus the other um, assets that we're showing here. 10-year Treasury yield dipped down for the week, although from the highs of the week, but up 2 basis points for the week. 10-year Treasury yield is down 31 basis points now. We do see a flight to safety occurring here, and we are below the 10-day moving average. And hopefully we would like to see 10-year Treasury yield breaking below the support. That would tend to be supportive in some sectors of the market, like real estate and construction activity. And we had noted before that there's a lot of Treasury refinancing this year to the tune of about $7 billion. So weakness in Treasury yields would be beneficial for refinancing. Let's turning to yield curve. The top line is the December 31, 2024. And for the week, last 2 weeks are shown in the blue and the yellow. Slight increase at the 20 and 30 year range, and but a slight decrease for 2 weeks on a 10-year, and slight shifting on the shorter end. We're still inverted at the short end up to about 3 years, which again does give us a little cautious outlook. Inverted yield curve, even at the short end, can suggest a recession. And also with the recent inflation data we've seen, the risk of a stagflation has increased, which does translate into investors being more cautious. Economic calendar, as we mentioned, key numbers are on Tuesday, ISM PMI, the JOLTS job openings. On Wednesday, ADP change, factory orders, crude oil stocks change. ISM PMI on Thursday. We also have balance of trade, initial jobless claims also Thursday morning, also pretty important. And Friday, non-farm payrolls, unemployment rate, and Powell's speech at 11:25. S&P 500 earnings, not much going on there, just ConAgra and Lamb Weston. So that's it, just a fair bit of macro news and headlines with trade policy posturing and additional tariff talk. It is quarter end today, so expect a lot of trading activity, rebalancing activity around quarter end. Hopefully things settle in a bit in early April. We'll be watching carefully to see if the tariffs are implemented and what happens there regarding trade discussions, or we get further sell-off in the markets. That's it for our investment outlook for the week. Thanks for tuning in. Wish we had better news and more positive outlook, but we do expect more volatility. If any of our clients or prospective interested parties would like more information, please feel free to email me or Jim Monahan, or be happy to talk to you directly and engage in any conversation you have. Thanks for tuning in. Market may be weak now, but we had noted that it had been overvalued, and large investors like Warren Buffett had been raising cash. So it's a good time to have dry powder, and hopefully people who've tuned in have heeded that advice. And we're going to sit back and watch how the markets play out here. We do have some more defensive posturing in our portfolios and are sitting on some cash waiting for better buying opportunities at more attractive valuations. And we do hope that the market settles in and the Trump administration and other governments and their settle in with their policies and provide some stability. Thank you very much and have a great week. We'll talk to you again next week. Take care.